Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about tariffs, mortgage rates, jobs data, and more. First, I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
Sarah, it has just been a crazy, fun-filled, nerdy week with tons of things happening. So I'm very excited because it's been a while since we've had a week like this, and a lot has gone on. This is Thursday morning. We just got the jobless claims number, the Challenger jobs cut data. Jobs Friday, by the time this podcast comes out, will be out. So, of course, labor over inflation, that's going to be the big thing. But a lot happened this week, and we had a very, very sharp reversal in bond yields. We had stock sell-off. We had, I tell people, like, if you think about tariffs, think about Karate Kid. And tariffs on, tariffs off, tariffs on, tariffs off, right? And then it starts to make sense, where we're just, at some point, something has to happen, but a lot went on this week.
Okay, I think that is the very best analogy for what's going on with the tariffs that I've ever seen. So hopefully at the end, someone's stronger, right? Like this makes it stronger, all this on and off.
One of the things about going early aggressively and you keep on delaying stuff over and over, you have to pull the trigger, right? Either you pull the trigger on tariffs or you make a deal, but you can't just keep on delaying stuff and obviously we're going to have reciprocal tariffs come in April 2nd. People ask about that. It's just basically telling everybody, hey, listen, the tariffs you have on us, we're going to have back on you. So there's a lot going on, but at some point, in a serious way, you have to either put the tariffs on and leave them there forever because you need to change behavior, or you make some kind of deal. But this back and forth stuff is started. I mean, even some of my conservative friends are like, okay, listen, you're going to have to do something, make a deal or something like this. But I think it's getting slightly annoying by pulling stuff back off. So hopefully you get some clarity on this by mid-April of this year.
Right. Okay, so before we jump into jobs, let's talk just a little bit more about tariffs and specifically home builders, right? So President Trump carved out something for auto, the auto industry, at least temporarily, if nothing else. We have not seen that with home builders.
It'll eventually happen, I believe. It's funny. Yahoo Finance asked me to speak on their show yesterday, specifically on this, and their kind of discussion was: is this going to boost home prices? And of course, the new home sale market is different than the existing home sales. We always separate those two. Why, Sarah? Because it's a Fight Club rules. We legitimately have functioning men in America, Russia, China, and Iran, who literally go around and told people that national home prices were down 15, 20% because they can't read that the median sales index has the census. It's a new home sales. And we just that's why we created the Fight Club rules. You would think somebody in their 20s, 30s, 40s, and 50s could read, but no. So the discussion is that, lumber prices escalate and it'll boost inflation and home prices will go. That the new home sales market is in a different stage right now. And so lumber prices were $1,000 higher during COVID, but mortgage rates were at 3%. Now, completed units of sale are up, total inventory is up. The South is a problem for the builders. Mortgage rates are elevated. I know they come down a little bit, but this is not the environment where they can just freely push on costs, and it's more of a production issue. And this is why permits have been in recession lows for some time now. So you could see why the builders' confidence index just tanked in the last report, because it's one thing to have elevated rates, but then it's another thing to have tariffs. And we just don't have the setup yet right now to, the sawmills and the productions to, get that kind of cost in. So I'm pretty sure something will happen, but again, a little bit chaotic early in the year. And
you think so, Logan? A little bit.
Yeah, I just don't think the builders start issuing permits or anything more. Also, the remodeling sector, costs of everything going up. If that does happen, it makes that sector, and we have to remember that the residential construction workers aren't all apartment and residential single family builders. These are remodeling work as well. So there's a lot of toss ups, and this is why we said the wild card for 2025 before any of this drama happened was the builders, right? There was a lot of variables that were in place for this year that were different than the previous few years. And we show them in the charts and we try to explain them, and they're really critical to the economic cycle.
So one of the reasons that I feel like indirectly home prices could go up is that right now, you've had builders able to buy down rates and sort of like section off some of the, the demand. So if that's less, if you have less homes to choose from on the builder side, if they stop issuing permits, so that makes every standing house more valuable in some ways.
Well, majority of all inventory in America really comes from the existing home sales market, just because we have to think of this in this. The builders build a home, unless it's a spec home, they have a buyer in there. It's a contract. It's just getting from that stage. And they don't really have a lot of completed units available for sale. Even right now, I think it's like 120,000. The existing home sales market is this massive, just massive marketplace that any kind of shift can, within 2 weeks, you can have, in a sense, our new listings data can be more homes available than all the completed units of the builders going back 14 years, right? If you get 60, 70,000 new listings coming on per week, just 2 weeks actually overrides that. So the existing home sales market is more critical for the active inventory. But if the builders stop building, right, then if rates do fall down and demand picks up, mortgage buyers pick up, inventory slows down, there's not a lot of new supply in certain areas that matter. Of course, the South has been such a big growth spot for the builders for many, many years, and that's now their problem area. So a lot of people said, hey, that's great for home buyers. Say, do you really think home buyers are running around thinking life's great? Like I always think it's funny. People go, it's a buyer's market. Do you really think buyers are telling you, hey, I feel wonderful right now? So it's this supply and demand equilibrium. And you always have to separate the new home sales sector from the existing, because this is just massive. And this is a sector that sells house as a commodity. If you think of it as a commodity, then a lot of the things that builders are doing make sense. And this is why we wrote that article in 2021 that, hey, I know everyone thinks you're going to get a construction boom. You guys are all so cute, adorable kids. I love you all. But once rates rise, it's all going to come down, right? And
they learned their lesson. The builders learned their lesson. They're never going to overbuild again.
This is not so much of 2008. This is what the builders have been doing since the 1960s. This is why I like to show these charts going back decades and decades. There's a reason rates go up, builders construction goes down. Rates go, builders construction goes down. The 1974 recession, you look at multifamily construction, collapsed, right? It doesn't go down to zero, but the growth rate slows down. And the one thing about 2008, there was demand there. Like new home sales were booming back then. So the builders build off of their demand curve. But the previous cycle had the weakest new home sales cycle ever recorded history. This is where I'm like 100% different than everyone else. The builders did not underbuild in the last decade. There was missed new home sales in 2013, 14, 15, and 2018. It was the weakest new home sales cycle. There was too much supply, too much existing homes that were cheaper. Mortgage rates were low. Active inventory was higher. They were at a disadvantage because the products that were available out there was cheaper than what they were doing. And mortgage demand was very, very slow. So advantage, disadvantage. Now inventory was at all-time lows. Mortgage rates shot up, and the builders like, oh, hey, we have sub 6% mortgage rates, right? So in an odd way, for the first time in a while, they had the advantage over the existing home sales market, but that's slowly going away. Margins compress. It's harder to pay down rates. In that environment, you just go, oh, we slow things down.
Wow. I mean, so much to talk about. Okay, let's get to jobs because this is jobs week and what a crazy volatile week it has been. So what have we seen so far?
Okay, so we're going to explain this from last Saturday's tracker to it's Thursday right now. Okay,
Okay.
Jobs Friday, we'll see what it is. So we wrote in the tracker that the 10-year yield has already made a big move. You're really going to need much weaker economic data or stock sell-off to drive yields lower. You guys look at the 10-year yield, look at closing yields. You can see why I talked about that. It's almost going to be testing a double bottom. Stocks sold off, tariffs, GDP negative 2.8%. Bond yields went all the way down to 411 on the 10-year yield. We are literally 31 basis points away from my low end. I was like, man, when we start getting into that area, you really, but Fed policies up here to get down there, you really need the economic data to get weaker. Then Germany announced, oh God, we're suspending. We're going to build up our military to fight Russia at some point. So global bond market synchronization, the 10-year yield went up in France, the 10-year yield went up in Germany. Our bond yields had a reverse. Stocks stopped going down. Some of the economic data was not as bad going out. So ISM, some of the manufacturing data, the jobless claims data came today. The headline number came down. So bond yields had a very sharp reversal. But if you look at it on a closing basis, we just basically tested a key level and we bounced off of that. But the drama was really, really big this week. And we always say that when you see crazy intraday action, short term, that's either a top or a bottom just because bond traders are still confused. And the labor data is key. The Challenger job cut index had a vertical spike. A lot of that is federal. You had some retail bankruptcies that were laid off. So we're a little bit more mindful now of labor data. But it was chaos this week. It was like Anchorman. Boy, that escalated really fast.
Okay, well, let's talk about the federal data. That's not going to be like, so tomorrow's jobs report is not going to reflect most of those layoffs, correct?
I don't believe it should, but again, bigger picture. There's over 162 million people working. 1.5 to 2 million people lose their jobs every month, right? It's the job hires and fires, a disproportional gap. If you're a growing economy, you still hire more people. Job growth has been slowing down. So we're going to have a couple 100,000 federal workers lose their jobs. In the big picture, that's not big. However, how I try to explain this is that last year, job growth was boosted by government workers. A lot of that is state and federal. If you're withdrawing money out of the system and the labor force stays constant or rises, that total payroll is coming down. Because of that, the unemployment rate can go up. If the labor force contracted, right, and it's the unemployment rate can stay lower, but if the labor force is on par or growing and your job growth, total growth is slowing down, then the unemployment rate could go up. And then we talk about that 4.3% number for the Fed starts to become more important. But yeah, I mean, every day I'm just looking at, we're firing 80,000 here, we're firing 50,000
Right.
here. So it eventually comes, but that eventually ends, right? And after that, if the labor market could absorb those workers into that, then it's not that big of an issue. But the private sector is really the big drive. I mean, federal workers is not that big in the total picture. So we're keeping an eye still on the housing sector because the residential construction workers, manufacturing jobs were already lost last year. So we want to put all of the focus on the key sectors out here. But clearly, if you're firing people and you're withdrawing money, the growth in one of your sectors that you relied on the previous year is obviously not going to be the same. So we see it in the data. We're going to see it in the jobs reports. But then again, it's a one-off, right? You can't fire everyone and then fire fake people. So it's really the absorption rate of how fast can these people get work.
So that's interesting if you think they're mostly concentrated in one area, because if you have 80,000 people flooding the market in one area, it's hard to see. I mean, the DC market is very federal jobs concentrated, right? So if the more people you fire in that area, they're either going to have to move or they're going to get jobs, or maybe there's some remote jobs, but it's like some of those things are pretty specific too.
And also, we have to remember one thing. I don't know how the severance or the payout packages go with government, but we have kind of like a white collar. Some people will say tech recession. I know in California, there's been a lot of tech jobs lost. A lot of these people have like good severance package, so they have time to find work and not get hit on the household side yet. So there's obviously government buyouts. I think some of the government workers are going to get paid like 8 months, if they took that. And I think those are older workers anyway. So we'll be able to catch this in the jobless claims data or the jobs reports. The job openings will be key. That'll come out next week, actually. So it gets intriguing because for me, I'm more focused on if the total growth of jobs slow down and the labor force stays constant or grows, your unemployment rate's going to get hit faster, that target. And what does the Fed do? And we're going to have a Fed meeting up soon. So how's that handling itself?
That's my next question is at what point does the pressure build on their own, like on their own levels they've said for the unemployment rate or whatever, like what happens? At what point do they feel pressure?
You know what? I could tell you this. What if I told you the Fed doesn't really care about all this?
You have told me this before.
What if the Fed goes, fine, if you want to withdraw money, that's fine. That fights inflation, right? So again, labor over inflation always, but the Fed made that target 4.3%. I believe that was purposely done to keep that low, that if something changes, they might change with it. I don't, until jobless claims and job openings data gets weaker, I think they're more focused on that. The withdrawing of money, I secretly think the Fed's like, okay, that'll make our jobs easier. Of course, another big piece of news, OPEC is now producing more oil. And that brought oil prices have not been able to really break under 66, 65 or something. We've been kind of in a downtrend, but we haven't broken underneath that. That can be a big deal, right? Headline inflation is CPI is really energy and food prices. They're probably happy about that, but the tariff discussion is getting a little bit more complicated because Democrats feel like inflation is about to take. Oh my God, the trade deficit data. Sarah, I know this is really exciting for you, but the trade deficit data just
I'm on pins and needles right now.
Oh my God. I sat there and I looked at it. I was like, holy, that's historic.
Okay, wait. So explain why this is a big deal.
So Trump hates the trade deficit because he thinks countries are ripping us off. But when the trade deficit grows, the U.S. economy does better because people are consuming. We're a consumption-based economy. We're not a manufacturing company. So we don't export. We're not like a third world country that exports cheap stuff to other countries that consume. So the trade deficit, which it's probably driving him crazy today, just got super wide because a lot of people bought stuff thinking, I got to get my stuff now before the tariffs, which the funny part is that the auto companies called the White House and say, hey, listen, we're going to have to raise costs if you do this on us. So tariff on, tariff off, right? They have a 1 month delay. So in that light, we're like, wow, a lot of people really did buy stuff before the tariffs, but that messed up the export or import. And then that hit the GDP negative, but it really was a historic push. I don't know how that continues anymore because you could only buy so much stuff. But that was really interesting to see how many people bought stuff ahead of the tariff. So some of the Federal Reserve people are now talking openly about tariffs, that some of their surveys are showing that costs are going to go up. Some of them say it's not going to really be inflationary in the big scale sense. They're one-time price adjustments. But you can clearly see behavior changed in terms of consumption by U.S. consumers trying to get ahead of the tariff. So it's different. This is just a whole brand new. So we're trying to incorporate. But oh my God, whenever I could explain the trade deficit data, I am so happy because nobody in America cares about that.
Well, maybe I bet some of our listeners care. You've found your audience here. It's not high on my radar, but that's okay. Really appreciate that. Okay, anything else this week that you wanted to delve into?
So, purchase application data. Okay, quietly, quietly, very, very, very quiet voice. Purchase application data has had 5 straight weeks of positive year-over-year growth data. Like nobody knew this. How we track purchase application data is a little bit different. We try to find rate ranges and where the data is going. So last year, mortgage rates went to 7.5%. Purchase application data on the weekly data had 14 negative prints, 2 positive, 2 flats. Very negative curve. The volume wasn't crashing lower at all, but the weekly data was highly negative. Because that was such a negative data line, this year, 3 positive, 3 negative on the weeklies, 2 flat. So in theory, we've already outperformed last year by just having 3 positive weeks. But because last year was such a hit when rates went to 7.5%, it really created a low bar. So we've had 5 straight weeks of year-over-year growth. Sarah, it has been a long time since I could say that. But looking at it in a little bit more sophisticated way, it's basically kind of flat. So there's not much really going on, but it is not as bad as last year.
So very interesting, the purchase application data. And, so we've seen rates come down last couple of weeks, right?
Yes, the mortgage rates have gone really from like 7.25% down to like 6.64%. And I just thought about Neil Young, "If You Go Away," and then
Wait, I don't know. What song are you referencing here?
no, we're just we brought Neil's song out because the mortgage rates got down to like 6.64%, and what happened was like I was thinking like, oh, if this just goes away, everyone's going to be sad, So it was a really big move down in rates from the recent high, and of course in that day the 10-year yield had that sharp reversal, and we had the second repricing. And the spreads get better when the yields go up. So mortgage rates are 0.5% better than where they were at the highs. But again, the key thing for me to teach people is that if I take the data, the seasonal demand curve out of the data lines, which is just the natural curve higher because more people get ready to buy in spring. The housing data only really improves when mortgage rates go from 6.64% down towards 6%. It doesn't really get good, 6.75 and above. So we're kind of right in that entry level point. You just got to get that next leg lower. And that's it's so frustrating. You're like thinking, all you need is to get from here to there. Yeah. And then you can get a little bit of growth in sales. And I'm not talking about like booming sales or anything like that. But the last few years has shown us when you're working from the lowest levels ever in history, it doesn't take much to move the needle. But we kind of got right to that point, and then bond yields reverse. So we are focusing on that going out for the rest of the year, but we are slightly better because last year was worse.
So let's talk about, last question, tomorrow, Friday, what are the chances that when those job numbers come out, that the 10-year yield gets ahead of the Fed and we have much better rates tomorrow?
Okay, so what you want to see for Jobs Friday is number one, wage growth not pick up. Fed does not like wage growth picking up. So if wage growth stays flat or goes lower, positive for rates. If job growth is slowing down, right, and noticeably, if you're sub 100,000, the ADP report came in negative by half. So that's not the most reliable data line. You keep an eye on that. Those two things, hours worked, stuff like that, that could be beneficial for the 10-year yield going lower. Because the one thing with the labor data this year is, again, the Fed left a very low bar to change. So this report and the next two or three reports will have all the Doge cuts in terms of firings, but I'm more interested on the money being withdrawn and how that affects other states and any state that has federal funding out there is at risk of slowing down. So I think that's why 2025 labor data will be interesting to see is it enough decrease in the spending to matter? So job growth slowing down, wage growth slowing down, that's all beneficial for rates. But the key is if the labor force stays constant or rises, that can allow the unemployment rate to go up. And then the Fed has to make a comment on this if that keeps on ticking up higher. So we'll see. This has really been a fascinating week. There's a lot going on. Trade deficit, Germany spending, the negative GDP data, all these things are happening. And then it's jobs week as well. We didn't have the job openings data. That'll come out next week. But we're getting to the point to where this is purposely done, and we see the aftermaths of it. And it's going to happen this year because it's been such a sharp withdrawal of money and people leaving. Is it enough to really tilt the private sector, which is that's what really matters. The private sector is what matters more. So I'm sure the White House is very happy that mortgage rates are heading lower. If mortgage rates kept on going higher and higher, the builders are just, so that I think for now, I think they're happy with that. But to get that, you got to get that next stage, right? You can get that 6.64 down towards 6, and you just stay there for a year, right? You can get something going, but be careful of like overreading too much on the purchase application data. Like if you read the headlines or thinking, wow, what's going on here? But internally, it's just basically flat. And last year was bad in that. So that's why we have that kind of the positive year-over-year data. So, it's just March. It's March, and I'm leaving to Boise again today. So
exciting.
We're getting the nerd tour going on. We got, I think like 20, 24 cities left to hit, but you really need like I always say everyone needs one good nerdy friend. Listen to the podcast. We will try to explain all. If any of you have an Instagram account, I have no life whatsoever. I literally sit there and just make videos about all economic.
You really do. You really are on social.
Like, oh my God, look at the trade deficit. Holy Toledo. And I was like, what's wrong with this guy? But we'll see. Again, we'll find out where the 10-year yield is going with the labor data, and then next week the job openings data is really critical because the Fed really likes that. The Fed's a huge fan of the job openings data.
All right. Well, Logan, thank you so much. And listeners, we will be covering this. We have lots of coverage as far as articles in addition to this podcast on these topics. So check us out. And Logan, thank you so much. Talk to you soon.
See you soon, Sarah.